I'm Jared Pratt, CEO of Granite Peak Associates.
I'm Heather Piazza, Tax Manager at Granite Peak.
We're a CPA firm serving the veterinary profession. We specialize in compliance, tax planning, and advisory service to take you and your practice from startup all the way through exit. And we're going to put our buyer's hat on here today. We're going to analyze this transaction. We got the financial information from a prospective seller. They've given us tax returns. They've given us internal financial statements. They've given us production and payroll reports. And now we're going to toss it on the screen here. We're going to define company value. We're going to see if the debt service works, meaning is there enough cash to pay back the bank? We're going to see if the cash flow works. Is there enough money to pay back the bank, pay my taxes, and still have some left over for myself as profit? So let's take a deep dive in here. We got the EBITDA on the screen. Heather, let's walk us through this analysis, starting with this column over here and take it from here.
Absolutely. So this spreadsheet on the screen now is our EBITDA calculation. So what we do, we start with the tax returns or the financial statements that were provided. Tax returns are typically on the calendar year versus the financial statements. We'll look at the trailing 12 months. First, we take just those items and put them in the spreadsheet. From there, we go through the numbers and we pick out adjustments. So we have our standard adjustments such as interest, taxes, depreciation, and amortization. And then we also look through the numbers to see, okay, in the eyes of a buyer, what is discretionary here? What's a one-time expense? What are costs that I am not going to incur? So as we're going through here, you're going to see a lot of items such as officer life and disability insurance. We have auto expenses. We have some professional fees. All of these items here are adjustments that we, as the buyer, are not going to incur. Typically, that professional fees, for example, is the cost that the seller is incurring currently to market the practice for sale, to incur those additional legal and CPA costs to get this practice ready to sell to a potential buyer. Charitable contributions, travel and entertainment, auto expenses, personal cell phones, those are all adjustments we look at as those discretionary one-time expenses that would be added back to what the net income is on the practice to get that adjusted EBITDA number.
So it sounds like if you want to tackle this on your own, your starting point here is get the information in a workable document as is. Make no adjustments, take it for face value. And all we're doing here again in this column is, hey, this is what you reported as the buyer, what the information, or the seller, the information we got. And then you're taking it a step further though, Heather, you're making those adjustments, which are purely discretionary, and identifying them, highlighting them, and what happens in this column over here, this adjusted column?
Once you do all those add backs or subtractions to what the current numbers are, you get that adjusted number. A lot of the big ones to look at, if you have one-time income, those might be from certain rewards from credit cards or points from your vendors. Under cost of goods sold, maybe you bought a lot of equipment last year that was put on the P&L that was a one-time cost. Jumping down to salary and wages, we have family members that are receiving payroll through the company. Well, those aren't going to be recurring for the potential buyer. So as we add in or subtract these related income and expense items, we get the adjusted column. That adjusted column will give you the true profit, true income and expenses of the practice as a new buyer would have walking in day one.
Yeah, and there's no way we're going to be able to cover, get into the nitty-gritty, the fine tune of every single add back or adjustment in a 10-minute clip. But I think the important thing is, let's not just take the financials at face value. If we're analyzing this practice, seller gives us information that says their profitability is 101 grand. After our adjustments, though, we've identified as, again, putting my buy hat on, well, maybe day one, I'm actually playing with 140 grand of profitability, not the 100 grand that the seller had reflected within their statements. The seller did nothing wrong. They ran the clinic the way they should have. But again, it's different perspectives. Me as the buyer is going to come at this with much different expenses than you as the seller had. So our analysis does not start at the 101,000. When we think of transitioning into debt service and cash flow, we're using our 139 grand, call it 140 grand, as the starting point for how we analyze and how we calculate everything there.
And that $40,000 of adjustments that we calculated can be a big difference in the purchase price of the practice. So say, let's take on a private sale, you're going to get a multiple of EBITDA of 4 to 6. If we jump in the middle, take an EBITDA multiple of 5 and multiply it by 40 grand of adjustments we found, well, that's $200,000 of purchase price that we wouldn't have gotten if we didn't perform this exercise.
Yeah, so it goes both ways. As a seller, I want to identify those adjustments using that multiple effect. Every $1,000 is $5 grand in your pocket. So it's important on that end. And then as the buyer, yeah, you want to make sure you truly understand how much cash is going to be available for you if you do not grow the practice at all. If any analysis we always do, if you start with the top, we're not factoring in a growth rate. We're just saying that you take over a clinic. You don't grow it at all. You continue to maintain and operate that. It doesn't shrink at all, but again, no growth. So we're taking a very conservative approach to the analysis. Again, just to make sure that, can I afford the practice in its current state?
And the goal of this exercise, especially in the eyes of the buyer, is will the practice itself pay for the purchase price, the loan payments after you obtain financing?
That's a huge point. We don't want you to acquire this asset and then be dipping into personal savings on a monthly basis, or using some of your W-2 wages to cover the purchase price of this acquisition. The profitability should be there so that you cover your tax liability on any current year profits, you cover all of your debt service, and then leave yourself some leftovers for either reinvestment into the business or reinvestment into your own pocket. So if we jump back down here, we got EBITDA. Again, this is a straightforward analysis. This was a single doctor practice. There wasn't too much in the way of adjustments. Some analysis, some EBITDA calculations that you'll see and have. There's going to be production adjustments, everything that Heather highlighted. But this one, let's take the 140 grand on its face. We're going to jump over a slide to what we call a debt service calculation. We're going to expand the screen here for you, make it a little bit bigger. We've identified, in this example, purchase price for the practice to be 750 grand. We want to make sure that the cash flow, the 139,000 that you saw on the previous screen, does that support a 750 grand purchase price? Most times you're going to seek traditional financing. Traditional financing is a conventional lender. Conventional lender will give you a term, meaning a loan repayment term. Think of your mortgage at home as usually 30 years. A bank is going to really lend you money generally on a 10 to 15-year repayment window. Most veterinary specific lenders are stretching out the debt for 15 years. The interest rate that they charge is based on the market. So today, interest rates could be 7 to 8%. 3 years ago, they were at 3%. So it really depends on the environment that we're in, and that's going to be a full, fluid discussion based on when you're going through with this transaction. When we look to the cash flow, we analyze, all right, what is our debt service? What is that monthly principal and interest payment that you're going to pay to your bank? We're going to calculate that. We're going to use our profitability, our adjusted profitability, as our starting point. And we're going to see at the end of the day, if I paid back my lender, if I paid my personal taxes, what's left over. If that number at the end of the day is 0, negative, or extremely small, it gives us pause or hesitation. Do we have the correct purchase price? Is that number too high? Are we buying the practice at a premium? And is it being valued at more than it should? Heather, what do you like to see for that buffer, that window on the back end on this highlighted cell here? How much cushion do you like to have when analyzing a deal?
Yeah, looking at this one specifically, we have a 50 grand cushion. That's a safe cushion to have when purchasing a practice. Again, this is after we pay back the bank. This is after we pay all tax liabilities. We still have that $51,000 cushion. So if something happens at the practice that might eat into your cash flow a little bit, we have this buffer that we're not going into our personal savings to put money into the practice to pay those associated costs.
Yeah, so if that number, typically if its number is 10 or 15 grand, that window, that kind of gets a little bit red in my opinion, that, all right, the one big expense, like Heather just said, could swing things drastically. If we go 30 grand or higher as a cushion, as a net cash flow after debt service and taxes, I get a comfort level knowing, yeah, purchase price, in this example, 750 grand, seems to be the appropriate ask, appropriate value that's been set on this practice. Another good test, I guess, Heather, walk us through percentage of gross when I say purchase price is 1 times gross or 75% of gross. What does that mean?
Yeah, so the biggest item there is what the bank will finance for you. So if your purchase price is at gross or below gross, the bank, a conventional loan, especially for a veterinary lender, will give you 100% financing at the bank level for that. However, if that purchase price is above what you're doing top line gross revenue, then you're going to have to look elsewhere for that additional, make up that difference between total gross revenue and what's being asked for purchase price. So the numbers might still work and might still be cash flow positive. However, if the bank's only giving you a certain amount, you have to look to either your own personal savings to put some money down, or you have to look into a seller loan potentially to get you to the total purchase price.
So as the buyer, I'm being told, look to percentage of gross revenue. Find a multiple 4 to 6 times of an associate buy and make sure there's a healthy cash flow buffer. If you look at this transaction that we analyzed here, me as the buyer should feel pretty good about the overall deal at a $750 purchase price. I know, again, at the end of the day, I got a healthy buffer, 50 grand in this example. My sales price to percentage of gross revenue is only 74%, so well under that 1 times gross. I know that I can take this to a bank and not have to worry about any type of financing concerns. In my EBITDA multiple, again, that 140 grand times a multiple is right in the middle of where associate or private buys are today. Again, that 4 to 6x window, we're coming in at 5.37 of this transaction. You've now checked 3 of the main boxes. Your cash flow is solid, you're under 1 times gross, and your EBITDA multiple is right in line with where industry says it should be. So, short of other outliers, the people, the team, the real estate, those are other things we certainly have to take into consideration from a pure financial standpoint. This deal is certainly checking a lot of the boxes to give me comfort to go forward and to get an LOI drafted.
And it's important to note, we're looking at the practice as is. So right now it's a 1 owner DVM practice. However, if there's room to grow to 2, 3 doctors, we're not looking at the potential to grow the practice. We need to look at it day one, today. It's a 1 doctor practice. We're not looking at it as the potential to get to that 3 doctor practice.